Audit planning. Audit planning. Importance of audit planning. It helps the auditor to devote appropriate attention to important areas of audit. It helps the auditor to identify and resolve potential problems on a timely basis. It helps the auditor to properly organize and manage the audit engagement so that it is performed in an effective and efficient manner. It assists in the selection of engagement team members with appropriate level of capabilities and competence to respond to anticipated risk and the proper assignment of work to them. It facilitates the direction and supervision of engagement team members and the review of their work. It assists where applicable in coordination of work done by expert team. An exam-focused overview. The planning stage of audit and overview. Planning, audit strategy, audit plan. Overall approach to audit. Detailed implementation of strategy. Understanding the client. Audit risk, materiality, scope, timing, direction. Description of risk assessment procedure. Description of further audit procedures. Understanding the client. The industry, regulatory, and other external factors, nature of entity and accounting policies, objectives, strategies, related business risk, measurement and review of financial performance and internal control, risk assessment through the understanding gained through analytical procedure. Analytical procedure evaluate financial information by analyzing plausible relationship among both financial and non-financial data. These procedures are conducted at a planning stage to assess the risk of material misstatement in the financial statement. Examples are given below. Compare client financial statement with prior periods. Compare client financial statement with budget or forecast. Compare client financial statement with similar industry information, sales to account receivable ratio. Compare client financial statement with auditor's own expectation. Proof in total. Evaluate relationship among elements of financial statement that are expected to have a practical pattern based on client previous experience. Evaluate relationship between financial and non-financial data. Payroll costs to the number of employees, revenue to sales volume. If explanation of the term audit risk. Audit risk is the risk that the auditor might give an incorrect opinion when financial statements are materially misstated. Audit risk has two components: risk of material misstatement in financial statement and detection risk. Audit risk is risk of material misstatement in the financial statement or detection risk. Detention risk of material misstatement in the financial statement is the risk that the financial statement might be materially misstated before the audit. So they are inherent risk and control risk. So detection risk is the risk that audited procedures will not detect misstatement in the financial statement. Possible reasons for high detection risk include inadequate planning, audit team related issues, lack of professional skepticism, inadequate supervision and review of work, incorrect audit procedure, improper sample selection. So what is inherent risk? Risk that the class of transaction or account balance disclosure is misstated before considering any controls. Control risk. Risk that a material misstatement in a class of transaction or account balance disclosure will not be prevented, detected and corrected by client's internal control because controls are not designed to implement it properly. Important. If risk of material misstatement in financial statement is high, the auditor will need to reduce detection risk in order to decrease audit risk. Materiality. Misstatement including omissions are considered material if they are expected to influence the economic decision of users taken on the basis of financial statement. Auditor determination of materiality is a matter of professional judgment. Material by amount for financial statement as a whole. Exam. 5% is of profit before tax. 2% is of total assets. 1% is of revenue. Material by revenue. Related party transaction. Bank. Items which affect debt covenants. Items which affect statutory items. Materiality may be revised at a later stage in audit. For example, if auditor gets new information or if there is a change in auditor understanding of the client. Performance materiality should be lower than the overall materiality level. The amount of performance materiality is considered necessary to reduce an appropriately low level of the probability that aggregate of uncorrected and undetected misstatement is greater than materiality. Risk and materiality are inversely proportional. Scope, location, branches. See, the planning stage. Okay, audit strategy, scope. The audit strategy, scope, location, branches, financial reporting framework, any industry specific regulation that apply, need of experts, reliance on internal auditors' work, use of service organization by client, use of computer aided audit techniques by auditor, report, timings, reporting deadlines, meeting with the management or TCWG, expected communication with the management, team meetings, review of audit work by audit partner, direction. Control plus substantive or mainly substantive to be explained later. Answer technique. Risk of material answer technique. Risk of material misstatement. Identify risk by using words from the scenario. If possible, write the relevant accounting treatment. Explain the risks. Ensure you mention which are on of the financial statement is are at risk of understatement or overstatement or misstatement. The answer has to be in by explaining chances of fraud or error in financial statement. Could be in an amount of or a disclosure. So first, identify the risk from the scenario by looking at the word of the scenario. If possible, what is the relevant accounting treatment, and we need to explain risk. Which of the item of financial statement is at risk, and uh, what are the chances of fraud in there? Okay, like that we have to explain. First is scenario. We have to identify risk and possible accounting treatment, and what are the chances of fraud or error. What could be the misstatement and what are the chances of fraud or error. Okay, three things. So this detection risk. Scenario. Identify from scenario. Explain how it would increase the chance of auditor not being able to detect material fraud or error. Risk responses. This is the area students struggle with the most. This is simply the auditor plan for the audit risk. That is what further work will the auditor do on a risky area as identified above. The plan could be some example. The auditor will test the control in this area, or the auditor will perform substantive procedure like this. Okay, or the auditor will have a look at the review stage of audit by performing some procedures. Okay, given examples are the further along in the notes. Detail of the overview that has been covered above. Audit strategy set the scope, timing, and direction of the audit. Guides the development of the more detailed audit plan. Audit plan. Once the overall strategy has been planned, detailed consideration can be given to each individual audit objective and how it can be best met. Understanding the client or knowledge of the business. The auditor obtains an understanding of the entity. It controls control environment, and it detailed internal control. to identify and assess the risk of material misstatement in the financial statement, and to provide a basis for designing and implementing response to this risk, to determine the extent to which the auditor will rely on the internal control system, to assess whether the team is competent to perform the audit, to understand the relevant law and regulation impacting the entity, to consider the reliability of various evidence sources. Understanding to be gained about industry, regulatory, and other external factors, for example, financial reporting factor, framework, laws and regulations, stakeholders, economic condition like volatility of exchange rates, competition level of technology, nature of entity and accounting policies, legal structure, ownership, governance, main sources of finance. Objective strategy, related business risk, example, new product services, explanation, use of IT. Measurement and review of financial performance. Measures important to the client. Key performance indicators. The budget, target. Internal control. Gain an understanding about the design and implementation of the internal audit. Miscellaneous. Identification of issue that arose in prior year audit and how these were resolved. Also, whether any point brought forward was noted for consideration for this year audit. Internal control deficiency noted in the prior year. If this had not been rectified by management, then they could arise in the current year audit as well. Significant changes in the entity as compared to the prior year. Is the company using e-commerce? Understanding can be gained from prior year prior year financial statement. Provides information which relates to the size of the client as well as the key accounting policies, disclosure notes, and whether the audit opinion was modified or not. Discussion with the prior auditors and access to their file. Okay, provide information on the key issues identified during the prior year audit as well as the audit approach adopted. Prior year report to management. If this can be obtained from the previous auditor or from the management, it can provide information on the internal control efficiencies deficiencies noted last year. If these have not been rectified by management, then they could arise in the current year audit as well and may impact the audit approach. Okay. The client accounting system notes procedural manner, provides information on how each of the key accounting system operates, and this will be used to identify areas of potential control risk and help determine the audit approach. A discussion with management provides information in the relation to the business, any important issue which have arisen or changes onto the accounting policies from the prior year. Review of board minutes provides an overview of key issues which have arisen during the year, how those charged with governance have addressed them. Current year budgets and management accounts provide relevant financial information for the year to date. It will help the auditor during the planning stage for preliminary analytical review and risk identification. The client website recent press release from the company may provide background on the business during the year, as this will help in identifying the key audit risk. Financial statement of competitors. This will provide information about the client's competitor in relation to their financial result and their accounting policies. This will be important in assessing the client's performance in the year and also when undertaking the going concern review.